Hey guys, welcome to our third part of our educational series. And I guess today we can continue building off what we talked about last time, talking about vol skew. And I guess to get started, let's tackle the first assumption of the Black-Scholes model, which is an incorrect assumption, but the assumption is that we have flat volatility across different strikes and different maturities. And in that case, we essentially believe that the distribution of outcomes is a normal distribution. And so why is that wrong? I guess I'll draw it out just to demonstrate. So to sort of like demonstrate the effect of, I guess, vol smile on the, I guess, risk neutral probability, we can plot this in sort of two parts. The first part is, let's say we assume flat vol across all strikes. This will map out to a volatility that sort of looks like this, a normal bell-shaped normal distribution. And then let's say we're to take our second part, which is a curved volatility smile that corresponds with the same strikes. In that case, it would look something more like this. Now we can obviously see that these two distributions vary significantly due to the change from flat vol to sort of the curved vol smile. And so I guess to give some historical context, as vol research evolved throughout the years, sometime in the like 70s or 80s, practitioners sort of came to the conclusion that implied vol follows a stochastic process. And this parallels to the process of the underlying asset and I guess is correlated to it if not governed by the underlying asset dynamic. And so, with that in mind, why do people still use Black-Scholes in the real world? Well, despite its flaws, I guess the Black-Scholes model has one advantage, and that is that it is a robust mapper between, I guess, implied vol, price, and then the Greeks. Um, And while I guess it's debatable whether the assumptions are actually valid in real trading, we could definitely use it to move from sort of the vol space to price. All right, remember how last time we were talking about our option can be split into two parts, one being its intrinsic value, and the second being its extrinsic value. And these two parts can also be thought of in derivative terms, right? Intrinsic value can be thought of as our delta exposure, and our extrinsic value can be thought of as our vega exposure. Now we can already see that both our delta and vega are sensitive to a change in the underlying spot or vol, which means that our options book is likely to incur a profit or loss as they move. And so that leads us to a very important question, which is what vol should we be using to price and manage the risk of our options book? And should we even bother moving that vol at all? Well, we know that as our time to expiry decreases, our time value decreases by the square root of time. And this is because, if we remember, as our option approaches that expiry date, the time value decays at a faster rate as it approaches that date. Um, and so this leads us to a follow-up question, which is, assuming that we hold our option to maturity, should we even bother to account for the change in volatility? Well, to answer this, we need to note two important factors. One being that moves in implied volatility and realized volatility tend to be correlated to some degree, and that degree tends to change as market regimes change. And so hence, a move in implied vol is likely to come in conjunction with a move in realized volatility. The second part is if we aim to exploit that sort of dislocation in implied volatility, uh, it only makes sense to mark our positions according to the traded volatility. And so we can already see that there seems to be a negative relation between the change in strike price and the change in volatility. And so we can comfortably assume that uh, the covariance between our spot and our vol is negative. And so, as we noted before, volatility follows a stochastic process and is driven by the move in the underlying asset itself. And so that means as the underlying asset moves, implied vol will move as well. And we also see that the increase in vol is nonlinear. And so what does this mean? It means that the rate of change of the volatility, which we can call vol convexity, increases as we move lower on the strike axis. Or in other words, the vol of vol is greater than 0. All right, so by now we know that our implied vol is driven by the underlying spot dynamic, and we know that the change is not constant. So in other words, it has a convex nature to it. This is where things get more interesting because we understand that our options book vega exposure has a significant effect on our book's P&L, and we want to measure how this exposure changes with respect to changes in spot and vol. And so these two sensitivities have their own name. One is Vanna, the other is Volga. And so our Vanna is essentially our derivative of vega with respect to change in spot. And then our Volga is our derivative of vega with respect to vol. All right. And so now knowing that our vega exposure has second order derivatives, we can rewrite our options book P&L sort of as a function of two parts. So our P&L can be thought of as a function of spot and time value. And the two parts are essentially our delta exposure. So delta plus our second derivative is gamma. And then our second part is our vega exposures. And so those second derivative exposures are Vanna and Volga. All right. And so this formula, I guess, essentially represents a Taylor series style decomposition of how our portfolio's value changes due to one, our price risk, which is our delta exposures, and then also to our volatility risk, which is our vega and second derivative vega exposures. All right, so now let's say we take on a position that has a large vega risk. Obviously, the most intuitive and straightforward way to offset our vega risk is to buy options, right? As this will add long vega exposure to our book and reduce the sensitivity to our book to a parallel shift in volatility. However, there are two major caveats to this. One, frequently hedging our vega risk is costly. It's expensive to hedge due to the high transaction costs and fees. Two, any option that we add to our book adds another subset of exposures. And so think about an option as a subset or a vector of risks. And so by adding options to our book, we accumulate multiple different subsets, which can turn our options book risk profile into something that we don't intend on. And so we sort of established that frequently trading options as a vega hedge is inefficient. So how do we efficiently hedge that vega risk? Well, we can always turn to our good old underlying asset. So we can either trade our spot, our forward, or our future, and use it to hedge our vega. Now, I know what most of you are probably thinking. How the hell do we take a linear product and use that to hedge a nonlinear risk? Well, that's where Smile risk comes in. So what is Smile risk? Smile risk is essentially, what's implied by the name is the risk that comes from the shape of our volatility smile, and that corresponds to our vega-related exposures. And so that is our vega, our Vanna, and our Volga. Let's move on to the delta hedging and delta adjustment part. Let's first start off by acknowledging that the Black-Scholes model assumes continuous delta hedging, which is pretty much impossible in real life. It's way too expensive. And the matter of the fact is we hedge discretely. So furthermore, we already know that Black-Scholes delta pretty much underestimates changes in volatility level and also underestimates the cross effects between spot and vol. And I guess lastly, as we've seen earlier, moves in vol in most cases are pretty correlated to spot moves. And so it only makes sense to incorporate that effect into our delta calculation. And we should hedge our vega exposure with an adjustment to that theoretical delta. And so we can sort of rewrite our delta to account for the smile risk using this formula. So our delta, our smile delta, is pretty much our Black-Scholes delta plus our, I guess, smile risk multiplied by the derivative of vol over our change in spot, right? And that makes sense, right? We add our vega and vega-related exposures to our delta and then multiply it by the expected change. Now let's talk about sticky strike and sticky delta. So not all markets are the same, right? Trading in equities is different from trading in rates or FX or commodities. And that means there's different practices that are applied to, I guess, quoting conventions in the volatility space. So starting with, I guess, sticky delta, this is mostly used in FX options and in OTC markets. And this quoting convention basically means that the implied vol level of any option is dependent on a fixed delta strike. So for example, if you've ever hung around the FX options traders, they'll quote things using 25 delta put calls or 10 delta put calls. And this convention essentially means that as spot moves lower, the fixed delta strikes remain sticky, or in other words, they don't change. Sticky strike, on the other hand, means that volatility for each strike is independent of a movement in the underlying asset. So, in other words, fixed strike volatility, right? All right. I guess the reason I wanted to mention this distinction between naming conventions is because I guess it would make more sense if you've read a paper called Riding the Smile by Emmanuel Derman, which you could probably find on Google. But riding the smile essentially means that we're sort of taking advantage of these quoting conventions and maybe like quote unquote arbitraging to sort of profit from the move in the implied volatilities resulting from a move in the underlying spot. And so let's say in a sticky strike world, we would incur pretty much no profit or loss as the spot moves, as the volatility of the fixed strike is pretty much independent from the spot dynamic. However, in both cases, smile delta hedging, a short vega position would actually outperform the Black-Scholes delta hedging in a declining market, while it would sort of outperform the BS delta in a rallying market. So to summarize, that pretty much means that when you incorporate that smile delta into your delta hedging, you end up just saying that when we hedge with smile delta, we're pretty much exposed to the direction of the market. That's pretty much the exact opposite of what we're trying to do. So what is the right approach when it comes to sort of estimating this spot vol relation? Should we assume sticky strike or sticky delta? The answer lies somewhere in the middle. So as volatility is more of a like clustering issue, or maybe a regime clustering to be exact, than a prediction of value. It really depends on the market regime. So when the market is, I guess, in a risk-off, let's say we're in a risk-off market, for example, implied vols tend to outperform the smile. And so at a minimum, we should assume that strikes are sticky. But when the market is sort of like drifting or in a crab market, we have more often than not, implied vols tend to underperform the smile, sorry. And so assuming sticky delta is more adequate in that case. And so as I said earlier, our smile adjusted delta is basically just sensitive to our model or our assumption. And I guess with that, all I'm trying to say is that there's no one volatility model that fits everything. So like, for example, if you look at the rates market, you probably use a Sabre model. If you're in the FX market, you're probably using Van Volga, maybe equities, you're using a Heston model. Essentially what we're trying to say is that there's no perfect model that fits every dynamic, and you, I guess, have to take into some discretion how you choose to model your own volatilities. That essentially wraps up lesson number 3, and I will see you guys in the next one.